Gold prices are on fire. On April 22nd this year, gold crossed 1 lakh rupees per 10 grams, an all-time high and a psychological milestone for Indian investors and households alike. But while the headlines focus on gold's glitter, a quieter transformation is underway in the jewellery business. From consumer behaviour and inventory dynamics to exports and retail formats, India's top jewellery companies are navigating a drastically different landscape. High gold prices mean higher ticket sizes, but also more cautious buyers. So how are organised players like Titan, Kalyan Jewellers and Thangamayil adjusting their strategies? Who's gaining ground, who is struggling, and what lies ahead for the jewellery industry? Welcome to Bottom Line by Grow. I'm Radhika Bajaj. In today's episode, let's analyze how India's biggest jewellery players are managing through record high gold prices, shifting consumer preferences and supply chain complexities while still delivering profitable growth. Gold prices in India have seen a remarkable surge over the years, and the rally has intensified in the past 2 years specifically. This comes against a steadily depreciating rupee, reinforcing gold's role as a long-standing store of value for Indian consumers and investors too. But what's been pushing gold prices up? The key factors driving gold prices are heightened concerns over the economic fallout from US tariff policies, fears of a US economic slowdown, a decline in the dollar index, increased central bank buying, and strong retail demand. But ever wondered how gold prices impact jewellery companies in India? While jewellery stocks typically tend to benefit from rising gold prices, the relationship between them is actually complex. That's where the organised players have an advantage. They are better positioned to offer value-driven designs and flexible exchange schemes, helping sustain volumes even in a high-cost environment. On the downside, one of the biggest concerns is cash flow. Elevated prices make restocking expensive. Retailers, especially those dependent on local manufacturing and tight payment cycles, may find it difficult to replenish inventory quickly, leading to a potential liquidity crunch. Another concern is the inventory losses. While companies with old, low-cost inventory benefit, those unable to hedge gold price risks effectively can suffer losses if prices fluctuate too rapidly. Sudden dips after a prolonged rally can erode margin gains for those who have stocked up at high prices. Also, high prices often deter new purchases. Many customers opt to exchange old gold ornaments instead of buying new ones. This trend has been clearly visible in recent months too. Despite the conclusion of inauspicious periods in early 2025, reports show a drop in fresh jewellery demand during January and February as consumers adopted a wait and watch approach. That is, demand dipped in the January to March 2025 quarter by 25% year-on-year due to soaring prices, marking the lowest quarterly volume since Q3 of 2020. However, the value of demand was up 3% year-on-year, highlighting how rising prices have compensated for weaker volumes. Having said that, for leading players like Titan and Kalyan Jewellers, elevated gold prices also present an opportunity. Several factors work in favor of large listed jewellers during such periods. Firstly, there are inventory gains. Companies that procured gold at lower rates earlier and manage inventory efficiently stand to benefit significantly. Selling at current high prices boosts gross margins, particularly for retailers with strong inventory cycles like Titan and Kalyan Jewellers. Secondly, there are premium offerings. Rising gold prices allow brands to introduce value-added services, customization, designer collections, and exclusive product lines. These offerings not only meet evolving consumer tastes, but also enable jewelers to command premium pricing, improving profit margins. And third, let's talk about the gold demand tailwinds. Indian gold jewelry remains highly sought after globally, especially in markets like the Middle East, Europe, and the United States. With gold prices up and the comprehensive economic partnership agreement with the UAE in place, Indian exporters enjoy duty-free access to over 90% of product categories. This opens up an avenue for increased export revenues, benefiting players with global ambitions. That said, gold jewelry retailers are adapting to gold price fluctuations. To cope with the rise in gold prices, jewelry retailers are tweaking their product designs, offering lighter, affordable collections and pushing 18-karat gold over the traditional 22-karat gold. Another trend gaining momentum is jewelry exchange. Old for new deals now make up 40 to 45% of sales in some chains. Further, gold buyers generally prefer branded retailers over unorganized players, giving a boost to the listed companies. The shift to the organized market is led by growing consumer trust in branded retailers, rising disposable incomes, government-led hallmarking regulations, and a rising preference for lightweight, everyday jewelry that fits modern, dynamic lifestyles. As such, large organized players like Titan, Kalyan Jewellers, Malabar Gold and Diamonds, and Senco Gold are aggressively capturing market share. They are deploying asset-light franchise models, introducing versatile designs, and scaling operations across urban and rural markets. This isn't just about design, it's also about margins. The higher the price, the trickier it gets to manage inventory, restocking, and cash flows. And yet, some of India's top players have managed to not just survive, but actually outperform. Titan Company Limited, for instance, saw its jewelry segment sales report a 25% year-on-year growth in Q4 FY25, though EBIT margin came in slightly lower at 11.9% in Q4 FY25 versus 12.1% last year. This softness in margin is mainly due to change in product mix. But a tighter overhead management has helped the company sail through the quarter and end the year in a strong performance. Kalyan Jewellers too reported an impressive 38% year-on-year jump in revenue in Q4 FY25. Meanwhile, Thangamayil Jewellery, a key regional player in South India, registered a 38% year-on-year growth in retail sales in Q4 FY25, driven by festive demand and a wider product mix. So most jewelry companies in the organized sector have managed to actually perform well. But behind the numbers lies tight operational control. While inventory days came down until FY 2024, they rose in FY 2025 due to the rise in gold prices and customers turning cautious. Kalyan Jewellers reported a sharp improvement in inventory days, down from 191 in FY24 to 162 in FY25, reflecting stronger stock turnover and capital efficiency. On the other hand, Thangamayil's inventory days rose from 128 to 161, indicating higher stock levels amid rising gold prices. To capture the shift towards organized market over the past 4 years, jewelry retailers have been expanding rapidly, with nearly 500 new stores expected over the next 2 to 3 years. The expansion push across organized players continues at a breakneck pace. Kalyan plans to open over 292 showrooms in FY26 alone, up from 71 in FY24, while Titan is on an expansion spree too. Its total retail footprint rose to 3,312 stores as of March this year. As for the latest data, organized jewelry retailers like Titan Company Limited, Kalyan Jewellers, and Thangamayil Jewellery Limited hold nearly 36 to 38% of the market. This is data as of FY23. And by the way, this is up from just 22% in FY19. This market share is expected to keep growing in the coming years. Having said that, even as the top players adapt, the gold jewelry sector is not without its challenges. Export orders have taken a hit due to US tariffs and slowing Chinese demand. While domestic demand is stable, it's increasingly price sensitive. Gold import duties, though recently reduced, still leave room for grey market arbitrage. With gold significantly cheaper in the Gulf, smuggling remains a concern, especially in southern ports. Regulatory unpredictability, frequent tweaks to import rules, hallmarking mandates, and tax norms adds another layer of complexity. Moreover, younger customers are changing the game. They want trendy, lightweight designs, flexible return policies, and a strong digital presence. For traditional jewelers, this means rethinking not just product strategy, but also marketing, loyalty, and in-store experience. So what's the big takeaway? Well, India's jewelry sector is no stranger to volatility, but the current wave of high gold prices, shifting buying patterns, and global macro risks is testing even the most seasoned players. What sets the winners apart is their ability to stay nimble, manage inventory smartly, and keep evolving with the customer. As such, investors, while investing in jewelry stocks, should focus on certain metrics such as cash inflows, market share expansion, inventory management, amongst others. So from Titan's design innovation and brand power to Kalyan's regional agility and Thangamayil's operational focus, the story isn't just about gold, it's actually about strategy. Do you invest in gold or gold jewelry stocks? What do you think about the jewelry stock outlook? Leave your thoughts in the comments, and for more insights, subscribe to Bottom Line by Crow.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing. Please read the risk disclosure documents carefully before investing in equity shares, derivatives, mutual fund, and or other instruments traded on the stock exchanges.